Everyone can't stop talking about VTI, and this talk isn't cheap. VTI has over $280 billion invested in it, making it the fourth most popular ETF in the world. But is VTI right for you? You don't want to lose thousands of dollars buying a terrible investment. If you get paid $20 an hour, losing $10,000 on a bad investment is like throwing away 3 months of your labor. To avoid this, let's make sure you know more about VTI than the average VTI investor. VTI is the ticker for the Vanguard Total Stock Market ETF and is investing exactly how you would imagine. VTI buys up the entire stock market except for non-US companies, meaning that the fund doesn't invest in roughly 45% of the total stock market. Still, having one fund buy up so many US companies is a huge win for the common investor. Tons of incredible US companies today entered the stock market long before you ever heard of them. Apple joined in 1983, Microsoft joined in 1986, Amazon joined in 1997. Instead of waiting for them to grow and then invest in these incredible companies at a high price, a total stock market ETF will buy these companies when they're cheap and unknown. This reminds me of a not so famous saying: if you take a blind man to a shooting range and let them take enough shots, they will hit the bullseye. I can't tell you what the next Apple, Microsoft, or Amazon will be, but I can tell you that somewhere within VTI's portfolio of roughly 4,000 companies, there is a high chance it's already in there. Since the fund is buying so many companies, it must be extremely expensive, right? Wrong. VTI is incredibly inexpensive. VTI's expense ratio is only 0.03%, meaning you only spend $3 every year for every $10,000 you have invested in VTI. Remember, keeping your investing fees low is very, very important. Your financial goals don't involve buying a fund manager a new Mustang. By minimizing your fees, you maximize the portion of your investment's return that you get to keep. VTI's expense ratio looks even better when you realize that Vanguard keeps lowering it. In 2017, Vanguard reduced VTI's expense ratio from 0.05% to 0.04. Then in 2019, Vanguard reduced the expense ratio again down to 0.03%. Decisions like cutting fees is why investors trust Vanguard with managing over $7 trillion, making Vanguard the second largest fund manager in the world. This trust is backed by Vanguard's unique business model that has saved investors hundreds of billions of dollars. Most fund companies have private or public shareholders. The fund company charges fees to invest in their mutual funds and ETFs, generating a profit. The profit is then given to the shareholders. It's the business model you're expecting to see. Vanguard's business model is completely backwards, and it is awesome. Instead of having an outside owner, the people who invest in Vanguard's funds own the company, which means Vanguard doesn't want to make a profit because they would just give the money back to the people they made the money from. Therefore, when Vanguard starts making too much money, Vanguard cuts fees so they make less money. The world of finance has tons of scummy companies, and here is the opposite: a company that literally works for its clients. ETF stands for Exchange Traded Fund, and it's a way of buying a basket of stocks, bonds, and or other funds in a single investment. The big reason why ETFs are becoming very popular is because ETFs can be bought at pretty much any major brokerage for free. That's not true for many mutual funds, including VTI's mutual fund equivalent, VT-SAX. If you use Fidelity as your brokerage and you want to buy VTI, buying VTI doesn't have a transaction fee. If you try to buy VT-SAX, you pay a $75 transaction fee. Now let's talk about VTI's past performance. The reason I haven't mentioned performance until now is because past performance is the single most overhyped part of investing. Investing in a fund due to past performance is like believing yesterday's winning lottery numbers will help you win today. VTI's 10-year returns could be useful if we have another real estate bubble pop, followed by years of recovery, followed by a pandemic originating in China. But if we don't have that, then they're not very useful. Fortunately, you do have some insight into the future returns of VTI. VTI's future returns will roughly be what the United States stock market returns. If the US goes through a period where it outperforms current expectations, then VTI is going to rock. If the United States underperforms expectations, then VTI is going to suck. When you buy VTI, you are betting that the United States is a good investment. So is VTI right for you? Well, that's for you to decide. But before you go, I do want to answer the question that has been lurking in the background of this video the entire time. Do I invest in VTI? Of course I invest in VTI. Did you hear anything I just said? This thing is incredible.